Okay, welcome to the Wealth Flow. My guest today is Chris Picuro. He is a CPA, an MBA, a PFS, an ARA. Lots of acronyms there, Chris. But Chris is a tax strategist, and that's part of the reason that we have him on today. We're going to dive deep on some tax strategies, some things that maybe passive investors, active investors don't always think of. I'm super excited to have Chris on again. He was on our show about a year ago, and looking forward to sharing with the audience all of these various tax strategies. So, Chris, welcome.
It is an honor to be back. I truly enjoyed our first podcast episode that we did previously. It's an honor to be on this show. Teaching Tax Flow is our podcast, and we both have flow in it, so it's a natural fit to talk about things. And we know that taxes, if not planned properly, is someone's largest bill. So planning around taxes is important because ultimately one of the three laws of Teaching Tax Flow that we've created is that tax agencies are your involuntary business partner, and you are paying your business partner a percentage of your income or assets, which directly affects your wealth flow. So this is a great fit. I'm excited to be back on. I'm excited to talk about tax planning and strategy specifically for real estate investors, and looking forward to diving in.
Yeah, I am too. And this is one of those things, and just you and I just briefly talking ahead of the show, and obviously we'll jump into the various topics, but there was some misunderstandings even on my end with it. And so this is why it's so important to have a partner like yourself, to be part of a community like Teaching Tax Flow, so that you really know and can plan in advance for these events that you may have. So, Chris, maybe what we could start with is really passive investors, somebody that is potentially investing within a syndication or within a fund. And, what are some of the things, maybe the top. You can take as many of these as you'd like, but I would say if there's got to be common ones that people just are not thinking of, that they don't always consider until after the fact, or maybe until it's too late. So what are some maybe 5 tax strategies or things that a passive investor should be keeping top of mind when they are investing?
Right. Well, before we jump into that, and yes, I look forward to this. I think what we want to remember is that what the goal is for everyone listening to this should be legally and ethically reducing the tax you pay in your lifetime, not just this year. We're looking at reducing tax over the course of a lifetime. And it's really sexy on TikTok and Instagram to say, I'm going to get you this zero tax this year, and you're going to take all these deductions, right? But ultimately, we want to pay as little tax as possible over your lifetime. And the tax laws are written in a way, we say, like I mentioned already, that tax agencies are involuntary business partners. Some industries are tax advantaged, some industries are not. Some taxable income is taxed at completely different rates based on what type of income it is. So real estate's one of those industries that are very, very tax advantaged based on our federal tax code. And I know, Keith, you're in Texas, I'm here in the beautiful state of Tennessee, just south of Nashville in Franklin, Tennessee. So we don't have a state income tax, which is nice. We have some franchise taxes and such. So we're going to focus on the federal tax side of this. Of course, you're going to want to talk to your tax advisor when on the state level. But first step we have to consider is this. Section 469 of the tax code, it rolls out something called passive activity loss rules. So if you are a real estate investor, you're going to fall into one of two categories. You're either going to be considered a passive investor, which is the vast majority of investors, or non-passive investor. Okay. So a passive investor means that losses that are passive, so if you have a paper loss, those losses can't offset active income. So we've got to think mentality-wise, and I want you to think also, not all tax benefits have to be year one. In Teaching Tax Flow, we talk about diagnose, prescribe, and we use color-coded diagnoses based on our marginal tax rate to figure out what is your tax situation, because percentages get tricky, right? So if you're 25% or over marginal tax rate, you are a red diagnosis. So we've got red, green, purple, gold. What I want you to think about when you're a passive investor is focusing on goal diagnosis. You're like, goal diagnosis? What's this guy talking about? Well, maybe you did watch the Teaching Tax Flow podcast just on the diagnosis. But goal diagnosis is tax-free income and growth. Very hard to find, right? Tax-free income and growth. And so as a passive investor, we're looking at what could we do tax-wise and investment-wise to get you some tax advantages. Because Keith, let's assume you have a household that is in the 30%, for easy number, marginal tax bracket, right? So you've got, let's say, $250,000, $300,000 of taxable income, W-2 job, et cetera, et cetera. That means that if you have money in a bank account and you get paid, now bank interest is low, but let's say you got paid $1,000 of bank interest that year, 30% of that goes to our involuntary business partner, the IRS. You only get to keep 70% of it. So when we start talking about passive investors, what if your cash flow from real estate was tax-free? That's automatically a 30% raise based on having to pay your business partner, the IRS, a portion of your income. So when we start talking about passive investments, many of them are simply buying rental property, right? Single family homes that you could buy in, or you can buy into what's called a syndication, where you are hedging a lot of your risk. You're taking away all of the management, and you are buying into, I could personally, and I've bought into multifamily apartment buildings. I've bought into mobile home parks, a variety of different syndications. So just buying real estate, right? And even if it's cash flowing, chances are there's a tax advantage, and you're gonna have what we call goal diagnosis, meaning tax-free cash flow. So probably the base level tax strategy, we're just purchasing real estate that is managed by somebody else in general. So think about it like that. So that's one thing. Now, the next thing for a passive investor, I'm going to take a step back, because a lot of times people say, well, I'm not passive. I get phone calls and emails when the plumbing goes out. Here's the situation. The IRS says that there's a designation called, you might have heard of this, rep status. That stands for real estate professional status. And in general, to be a rep status person, you have to meet two qualifications. One, you have to have at least 750 hours of time, log time in a given calendar year into real estate operations. Two, and this is the bugaboo, it has to make up more than 50% of your professional time that year. So there are several people, several medical doctors, right? They have 750 hours of time into real estate, but it's not more than 50% of their work time. So they're not going to be rep status. And when you're real estate professional status, that's when the activity is non-passive. So let's go back to passive. Most people listening are passive. So I like just buy and hold real estate, really attractive. In general, and that's what I tell people, you're probably not going to pay tax on that income. And someone might say, well, I bought my first property. Usually, Keith, you see in your community, most people don't jump in and buy a $500,000 property in a neighborhood. Most people jump in at that $100, $130, $140 price point. Let's say they go visit our friends just south of Nashville, down in Huntsville, Alabama, huge, very popular market right now, growing. Buy a property for $110,000, and let's say their mortgage is, I'm just making up numbers, $700, and their rent's $1,000. So let's pretend nothing goes wrong and they're making $300 a month. Not bad, right? Well, because of the depreciation deduction, meaning you get to deduct the cost of that property, that rental property you bought for $100 and something thousand, you get to deduct that over a 27 and a half year period. You're probably getting a $3,000 to $4,000 depreciation deduction, and ultimately you're paying no tax, and you're getting $3,000 a year tax free. That is pretty attractive, and I think people underestimate the value of just buying, single family homes, or buy and hold real estate, whatever asset class that they have. If you have losses, so let's say a paper loss. So again, you're making $3,000 cash, but on paper, on your tax return, you probably have a little bit of a loss. You're like, that's second of the three laws of teaching tax flow. Cash flow and tax flow are completely different concepts. As a real estate investor, we think about cash flow. As a tax strategist, I think about tax flow. You think, what is tax flow? It's the tax benefit or burden of any of your financial decisions. So Keith, in this case, let's say I have $1,000 loss on paper. I get to carry that loss forward if I ever have passive income in the future, if I dispose of the property and offset the gain, but I still have $3,000 a year in my pocket. So first one, I know I was long-winded, but I was really walking through that mentality. First one is just going to be invest in buy and hold real estate in some capacity for that passive investor. The second one, which could be used by many different types of investors, but I like it for passive investors because typically passive investors aren't relying on the cash flow from the property for their living expenses. The 1031 exchange. What a 1031 exchange is it's really, it's a get out of jail free card. I love Monopoly. So it's a get out of jail free card from the Internal Revenue Service. And if you were to sell a piece of real estate, as long as you don't take any cash out of that deal and you reinvest the gross sales price into another property or properties, you defer the gain on that sale. And the beautiful thing is, it doesn't have to be the same asset class. So Keith, let's say you owned I know you own not to get too personal, but I because I'm a fan of your podcast, I know you own property
Thank you.
Near the Smoky Mountains, right?
Mm-hmm.
An STR short-term rental. We're going to talk about short-term rentals. If you're out for a walk or jog or driving, you're saying, this guy just told me I have to be real estate professional status for non-passive. Don't worry, we'll talk about short-term rental loophole. There's a little wrinkle. But let's say you sold your property in North Carolina and you're like, man, that was great. I think I did a great job with it. I'm going to go invest in a fourplex in Dallas, in your home state. That's okay, right? You can 1031 exchange from a single family home or a vacation rental to an apartment building easily. So now there are obviously rules for the 1031 exchange. You're going to want to use a qualified intermediary. There are rules for identifying new property and for closing on property. But as a strategy, 1031 exchange is another really good one for passive investors.
No, that's good and great points there. And yes, you do have to name it. That you have an X amount of time, and maybe you can just for the audience, kind of run down. We don't have to get too granular, but you have to name the property in advance. You can name multiple ones if you're not 100% sure, and then you have X amount of time to close on that afterwards. But the key being that it does have to go, you have to work with an intermediary. You don't take any of the funds. I've had that question before. Right. I've asked that question myself many times. Can I take part of the gains, But no, you unfortunately, you have to roll it all over into the next property, but a great way to avoid or to, as you said, postpone paying taxes on it, maybe indefinitely.
It could be indefinitely. Absolutely. A third one. Now, you might not be, if you own a property, right? Typically, the first investment is going to be your primary home. And I've got a couple strategies just for that, because ultimately, it's still an investment, right? The cool thing is, if you own a primary home, you could be eligible for what's called the Section 121 exclusion. That's a capital gain exclusion. As long as you've lived in your property for 2 of the last 5 years, and if you file jointly, you could typically exclude up to $500,000 of capital gain. If you're unmarried, up to $250,000 worth of capital gain. You don't even have to buy another property. Those rules are long gone. And obviously, there are rules if you convert a property to a rental and then bring it back as if you have mixed use of the property. But that 2 out of 5 year rule is very beneficial. And to be able to walk away with $500,000 as a married couple of tax-free income is amazing. Now, remember I said tax laws are written to encourage and discourage behavior, and tax agencies are involuntary business partner? I want you to think about something. What's up with 2 out of 5 years, right? Doesn't that seem weird? Well, here's why. It's called Section 121. It's been around for a long time. You run for the House of Representatives. You live in Texas, and you want to be the only honest politician. I shouldn't say that, but you win. You go to DC, and guess what you're going to do? You're going to buy a house there. You're going to live there for 2 years, and then you're going to say, gosh, politics is not for me. I'm going to go back to Texas, and I'm not going to run again. You sell your home in DC. Of course, you live there for 2 years to the next slug that wants to be the rep. And you just walked away with up to $500,000 of tax-free income. So it was a gimme to in my opinion, and many people in the tax profession, the House of
I've heard that.
Representatives people. So just a fun fact, but Section 121 goes on to primary homestead. I'll give you one more for primary homestead is something called the Augusta Rule. You might have heard of that. Augusta Rule. I think it's 480A. Ultimately, you can rent out your primary residence for up to 14 days a year tax-free, named after the Masters. I don't golf, but I know enough about golf to know that the Masters is in Augusta, Georgia. Okay? So I look at our situation here. Live right outside Nashville. We typically in the summer go visit family in Michigan. A lot of times it's during the CMAs, Country Music Festival. As long as I know someone that know the people, I'm happy to rent my house out the week or so that I'm gone and put that money in my pocket tax-free. It's not considered a rental. You might live by a college town where you rent your house out on the weekend. There could be a variety of people that take advantage of the Augusta Rule, but just think that you can rent your house out for up to 14 days a year and pay no tax on that, not even reported on your return. So that's a pretty good benefit.
Yeah, for sure.
So yeah,
those are great ones.
And then, as far as for a passive investor, the other thing to consider, and now this is not as popular as it was once the Tax Cuts and Jobs Act came out. Let's say you have a rental property and you want to sell it, but you don't want to do a 1031 exchange, or you screwed up and you watched this episode, you should have watched it a long time ago, and you're like, I sold that rental property. The money's in my account. I really don't need the money. You have 180 days from the closing date to invest in a qualified opportunity zone fund. So you could still take that money and defer the capital gain. You don't even have to deploy all of the money. You could deploy some or all of your capital gain and defer the capital gain down the road in something called a qualified opportunity zone fund. So it's another strategy potentially for a passive investor. I'll give you one more because I said 5, even though this is technically my 6th. And this might sound funny, but cost segregation study. And usually that's something and we're going to talk about that when we get into the non-passive. Usually that's something a non-passive person would do. But here's what you could do. Let's say you sold a property, you did not do the 1031 exchange, you have a massive capital gain, and the hay's in the barn, right? The cash is in the bank. Well, typically passive activities are grouped together. So if you have a passive activity loss from property B, but you have a gain from property A and they're both passive, they net against each other. So you might want to do a cost seg study on one of your other properties just to create a passive loss to offset that capital gain. So, I mean, again, if you're listening, first of all, you're smarter for listening to Keith's content. But secondly, these are things that you're going to want to talk to a tax professional about, but there are strategies there. Take the mentality. If you don't pick your tax, the IRS does. You've got to do some planning and strategy to pick your tax and to take control of that burden. One more thing I would say for passive investors, this is a real case, Keith, real client that we were working with in our private CPA practice. It's a mature-aged woman. She owned a rental property right here in Franklin, Tennessee. They bought it 25 years ago for $200,000. The average price in this county is $1 million right now so you could see where that gain is. And she used to live there, and then she rented it out for many, many years. And she just sold it last year. And now she's like, oh my gosh, I have a huge tax bill. Well, guess what? Unfortunately for her husband passed away 4 years ago. We looked at the tax return. The preparer never took a step up in cost basis for the husband's passing. What that means to the listener is if you have property that someone inherits, even if it's a portion of a property, you get to reset your depreciation schedule, or what's called your cost basis, up to fair market value. So I know this is getting in the weeds a little bit, and you need to work with a tax professional to fix that because it is fixable, even if it happened 5 years ago. The point is, if you own inherited property, definitely talk to a tax professional, even if it was a spousal situation, to make sure that you've increased the depreciation, the cost basis, and get additional deductions. I love it, Keith, when you get additional deductions for not really spending a lot of money. They're already on your tax return.
For sure. And just to clarify on that, so the step up, I mean, you mentioned it's an inherited property. So when the person originally purchased it, obviously all of that depreciation was based on the value at that time. So they went through and they figured it up. Now this person has passed. It's been inherited by somebody else. You're still recognizing depreciation. In this case, it was really just passed to the spouse in the scenario that you mentioned, but it could have been passed to the children, whatever it may be. But now the value of that property is significantly higher. As you mentioned, 200K to now, $1 million. There's going to be a lot more depreciation that they'd be able to recognize. And that event of the death is causing the ability to be able to do the step up, or can you do a step up if you just have significant appreciation in your area without that?
Good question. You have to have a death, so it has to be inherited. So in the example I'm talking about, I believe the property sold for $900,000. The taxpayer and her husband at the time bought it for $200,000. They actually lived in it and then decided to rent it. At his passing, the property is worth $700,000. Right. So she's going to pick up the $200,000 to $700,000. That's a $500,000 of appreciation when he was alive. She gets to step up her basis for half of that. So we are reducing her taxable income by $250,000 just by identifying that this year. Now, I'm going to get technical for a second. Don't swerve off the road or yell at your dog if you're walking your dog. You should never yell at your dog anyway. But I guess there's times you should. But anyway, if they have behavior problems. So you would do what's called a 481A adjustment and file a Form 3115 with your tax return. Again, that's very technical. What I'm saying is typically when someone inherits a property, most tax professionals understand that the basis gets stepped up. So if I inherited a property from an uncle, it's new on my tax return, it's easy to pick up. It's often missed when you have spouse situation. And in some states, like community property states, you could get a double step up in basis, right? Up to the, in Tennessee, you have to have a special type of land trust to do that. But the point is, if you think about this and you have inherited property in your portfolio, talk to your tax professional and really look at your depreciation schedule. And it's fixable. Even if it's from 5 years ago, you could still fix it now. You can still fix it the year you sell the property on your tax return.
Yeah.
And when I say fix it, pick up that deduction.
That's incredible. And really for the audience, what I hope everybody is hearing, because there's a couple things, right? As Chris is explaining these various things that we should be aware of, that we should think of, he's also saying, well, now if you're in this state, it's this. But hey, if you're over here, you're this. This is why you need a tax strategist, right? Because there's just too much. This is what Chris does for a living, right? And there's just so many different scenarios and ins and outs within the tax code that it's impossible for the layman, investor to be on top of all of that. And so partnering with somebody like Chris and his team really makes a whole lot of sense.
Absolutely. And don't be discouraged if you talk to your tax professional and they're not aware of some of these things. That doesn't mean they're doing a bad job. That's why we're building most tax professionals are really focused on that compliance piece. They're looking back, grabbing data and preparing tax returns. There's not a lot of people looking forward, right? And I love that I'm in a season of my career that instead of, feeling like we're always putting out fires, we're lighting fires. We're lighting fires to help people save on taxes. Not, oh my gosh, when we're putting out fires, that's usually not a bad thing. And that's why we built our teaching tax law community. So again, if you've got tax planning and strategy, it complements tax preparation, but they're completely different things. So if you're working with a tax professional and they might not be aware of some of these rules, it doesn't mean they're uneducated. It doesn't mean they haven't done a good job for you in the past. It just means that you've gotten to a situation that's very specific that they haven't handled yet, or they might not have the experience to handle. So it doesn't mean that it's bad. We truly believe in collaboration over competition.
Yeah, for sure. Yeah, and sometimes it's just not something that even with my first tax or cost segregation study, rather, with my accountant, the feedback I got was, "Hey, that was a great idea. But it wasn't something that they had suggested or thought, "Hey, Keith, have you thought about doing this?"
Right.
But again, to your point, they're used to just processing the return on my particular one. They do a great job with that. It's just that's what they're kind of looking at when they're looking at their normal client, not necessarily looking for, "Hey, here's an idea out here. Maybe you haven't thought of. Have you considered doing this?" But that's more of the strategist position.
Absolutely. And we'll give you I'll give you some resources to jump in and join our community at the end. It's complimentary. So,
Yeah.
And a lot of people say, well, why do you do all this stuff complimentary? Some stuff. I'm like, well, I want to hear the questions, because if 3 people in our community ask the same question, first of all, that means we've got to create content. Second of all, someone in a private CPA practice is gonna ask the same question. So I want to have that content available for them in it, right away, instead of saying, well, let me look into that and I'll get back to you a week later. So
yeah, for
works
sure.
out well.
Well, so should we jump over? Is there anything else on the passive side that you want to cover before we maybe talk a little bit about active investors?
No, I would say on the passive side, if you're buy and hold, there's not as much, I guess. There are some strategies, but when you really, where tax planning and strategy comes in proactively is when you decide to reposition your portfolio and you're looking to sell. Then you've got some different options. There's one more thing. If you have a huge capital gain, so we've run into this situation now. I guess I went more than 5. So I don't know, Keith, you going to give me a bonus or something?
Yeah, exactly.
Oh, thank you.
No, I appreciate it. Keep them coming. Keep them coming.
So let's say we had a situation. We had a taxpayer come into the teaching tax law community. He actually owned a farm in Iowa. Very modest income throughout their life, and the farm was going to get purchased for development. Didn't have anyone in the family that wanted to keep it going. Looking at about a $2 million gain. Now, this person was probably living on about $40,000 a year. That's it. Doesn't need the cash, but if he sells it, he's going to give probably $250,000 to the government, and said, gosh, I'm kind of stuck. Didn't want to do a 1031 exchange. Never has been a landlord. Doesn't have an interest in doing it. But the farm was it was land, and he was operating the farm. So it was an operational farm. The point is, at that point, there was an option for something called a deferred sales trust. You're going to hear in the real estate community DST. DST, the OG DST. We like our acronyms in the tax world.
Right.
The Delaware Statutory Trust, which is a type of 1031 exchange. A deferred sales trust is going to be something different. But it allows you basically to create an installment sale treatment for the sale of your property. So, and that's always, I guess I'll give another one for passive investors. It's always another thing is, I've had a lot of clients that have built up portfolios over the years. They don't want to own the properties anymore. They like the cash flow. They don't want to pay a ton of tax. They'll sell their properties on a land contract to other people, a lot of times to their current tenants. And that allows them to still keep that cash flow and not pay the tax on the gain. So it really comes down to that taxpayer. Do they need that cash, right? And if they don't, then they have a lot of options.
Yeah, it's why it surprises me. We do a lot of educating, with, of course, the, fine print that we are not CPAs by any means, and for them to check with their CPA. But we do a lot of just educating of sellers, because there's so many, somebody who has owned a property for a significant period of time, that now this thing has become extremely valuable. That is just a huge consideration for them. That why would you want to take it all? Why would, for us as investors, the terms that we can put forth, we can work with each other, create a true win-win situation where, they're not getting all of the money at once, but they're getting that stream of income that they need, or whatever their particular scenario is. It's going to obviously change from client to client and from customer to customer, but there's so many ways that you can work with a seller to really be able to help offset any initial taxes, or just minimize their tax burden by them actually being the bank and being the holding the note on it. So
absolutely, yeah. It all comes down to just in general planning. Like, I want you to think about this when you go to sell a property. You stage it, right? If you want to max out the value, is it illegal, unethical to stage a property? No, you own the property. So why don't you stage your tax return based on the rules that we have? Why are you just giving it up for what, you think you want your buyer to walk into your house with your kids' stuff all over the place, or you haven't done the dishes from the night before, or do you want to put your best foot forward? So stage your tax return legally and ethically by doing tax planning.
Yeah, yeah, makes a lot of sense.
Well,
Okay, anything else on? Well, before we jump, tell me a little bit more about the DST, and you said that's a deferred. Uh,
yep, sales
say it
trust.
one more time.
Yep, deferred sales trust. So what's happening? So let's take a step back. One tax strategy for someone that's selling a property that maybe wants to keep the cash flow but doesn't want to have a big taxable event would be to do an installment sale. So land contracts. So let's say, Keith, I've got a property, I've owned it, I've paid it off, I'm getting rent, I'm kind of sick of owning it. The tenants really love the property, and I say, why don't I just sell this to you? And I'll be the bank. You could pay me a fair interest amount. You own it now. You feel good about your land. Your property taxes will go down. It'll be a primary residence exclusion. It's just a win-win. I get to spread the tax out on that gain over the course of the land contract. So if it's a 10-year note, 15-year note, assuming they don't refinance early, and there's strategy behind that, then that's an advantage to me as a seller. It's advantage to get a lower interest rate and a higher sale price, because capital gains are taxed lower than interest. And what you don't want is, you don't want them to go refinance in 2 years and now you're picking up all the income. So that's an installment sale. What a deferred sales trust does is it creates an installment sale treatment when you really don't have an installment sale. I'm selling my farm for $2 million. I'm going to create a trust. I'm going to first sell the land. I'm going to sell the property to my trust for fair market value, and the trust is going to sell to the end seller. The trust basically is a wash, and I pay tax as I take money out of the trust. So I can spread that money, that gain out. Now, I've just simplified something that's very complicated. And again, reach out to me, or Keith, you reach out to me. I can connect you with some people that you're going to work with a law firm. You're going to have to create this trust. In general, it starts making sense, at about $1 million worth of gain, just with the costs associated. But it also allows you to control it. Right? What if you got this deferred sales trust, and now we think that capital gains are going to go up 2 years down the road based on what we're seeing in a midterm election? Well, we might want to move some income into this year. It just gives you flexibility, and that's where taxes aren't a straight line. Different types of income are taxed at different rates in different years. In 1 year, you could pay double the tax you'd pay in a different year on the same amount of income.
Yeah, no, that's incredible. So, and that's another one of those that I had no idea. And for the investors that are listening, this is another one. I'm thinking of a couple of deals of just people I talked to last week who are like, "Hey, this actually could make sense for them if they didn't want to hold the note." I think on at least two of them, probably they'll end up holding the note. Maybe that'll be a simplified version of that. But the problem with that, as you mentioned, is that if I refinance, which in most cases I'm going to intend to do, right? If it was put in that trust, that's all. Just the sale happens, and it doesn't really matter what the seller does after the fact, or the buyer rather does after the fact. They can refinance whatever. You've already created this this trust where the money's just coming out at a certain amount. So very interesting. We'll have to explore that on another. I don't want to go too far down the weeds, but that's a very interesting one.
And this is going to sound like complete self-promotion. We have a whole podcast episode on deferred sales trust. We actually have one on Delaware statutory trust also. And we're up to like 130 or 140 episodes. It's kind of all a blur. But for those type episodes, we bring in an expert guest to really talk through it. Because am I aware of it? Sure. Can I diagnose when it might make sense? Sure. Am I the person implementing it? No, I leave that for the experts. So,
yeah, awesome.
So
cool, Chris. I guess let's maybe shift gears here and go to those active folks that are out there.
Yeah. So if you're non-passive, so in general, that's going to be real estate professional status, rep status. These are going to be people that maybe are a full-time real estate broker. Maybe they're doing house flipping. Maybe they're wholesaling. Maybe they're full-time syndicators. And they're going to be able to take any of those losses, those paper losses, on their tax return, and offset any other type of active income. Okay, so that's good. There's a big there's a big difference. So what are the best strategies for them? I'm going to try to limit it to 5. I might just go over because I get very excited about these strategies.
No
But the
problem.
first one I would say would be once you get in, okay, I'm gonna preface this by saying this is probably the strategy that's used the most overused. It's used too early, but S corp election. So if your profit's going to be, let's say, $175,000, $200,000 or more, that's where you could consider an S corp election. Works great if you're a real estate broker and the state you live in allows your commissions to be paid to an entity. If you're a very profitable house flipper, S corp election works really well, or wholesaler. It doesn't work well on buy and hold real estate. You don't want to put buy and hold real estate in an S corp. Or if you're a highly paid consultant or coach, S corp could definitely make sense. So I'm going to give you 5. They're not in any specific order. It's all about diagnose, prescribe, right? So S corp could make a lot of sense for our full-time real estate people. The aforementioned cost segregation study, by far the biggest bang for your dollar, lowest hanging fruit of any type of tax strategy. So with the Tax Cuts and Jobs Act of 2017, cost segregation studies went wild. We've been around for a long time. We've used them as a strategy for over 15 years. What is a cost segregation study? I'm going to try to explain it as simple as possible. When you buy real estate, okay, you have to deduct that real estate, and that's called depreciation. As a residential property, it's 27 and a half years. Why is it 27 and a half years? I don't know. Why didn't they just make it 28? Whatever. We don't make the rules. But 27 and a half years. If it's commercial, it's 39 years. Okay. So, and it's on a straight line. So easy math. Let's say you buy a commercial building for, I'm gonna make the math easy. $4.5 million. Let's gear it down. Let's go with the average Joe's. $450,000, sixplex. I don't know. Probably not the Class A neighborhood, but that's all right. And the land value, land's not deductible. It's deductible when you sell the property, but it's not depreciable. But let's say the building basis is worth $390,000. You would get a $10,000 deduction for the next 39 years because it's a real estate. What a cost segregation study does is it breaks out, it's going to be a tongue twister, the personal property portion of the real estate. Wow, what's that? Landscaping, windows, heating and cooling systems, electrical systems. You have a third party come in and they break out that portion of the property. So when we're talking mobile home parks, why do mobile home parks do so well in cost seg? Almost all of it's land, it considered land improvements, 15-year asset, and that's eligible for bonus depreciation. So we break out the non-real estate portion of the purchase into like 5, 7, and 15-year asset classes. And because of bonus depreciation, you can immediately deduct a good portion of that. In general, we're looking at about 24% is the average across all different asset classes of personal property in real estate. So in the apartment building, about $100,000 of the purchase price is eligible for bonus depreciation. And then you look at, when did you acquire the property? Well, back in the good old days, which is only a few years ago, bonus depreciation was at 100%. So you would have gotten a $100,000 deduction. And since your real estate professional status, that $100,000 deduction can offset your real estate commissions if you're a broker. It's pretty attractive, right? Right now, and as we record this in 2025, bonus depreciation is at 40%. There's a lot of chatter that it might go back up to 100%. There was a bill that went through the House in 2024, HR, 7401. I don't know. I'd have to look it up. I probably shouldn't do that on a live podcast. But it basically said that law went through the House, got stalled in the Senate, that said we're going to go retroactive to bonus depreciation of 100%. So I wouldn't be shocked if we got to that level again. However, even at 40%, that's a very attractive deduction. So that's a cost segregation study. And here's one thing I'm going to leave you with the cost seg study. If you bought property at any time between September of 2017 and now, and have not done a cost segregation study, and you're an active real estate person, talk to a tax strategist. Keith, let's say I'll just use these are real cases. They're so easy. I've got a client, real estate professional status, bought a property in Florida down the Space Coast. But basis was $1.2 million land in or building basis. Went straight line depreciation. Again, rep status. And we're scrubbing their depreciation schedule. And I'm like, you never did a cost seg on it. Oh, I didn't know I could do that. Well, yes. We picked up a $350,000 deduction. They bought the property in 2021. We're filing their 24 return. We could take that deduction in 24. And this is someone that the one spouse is a medical doctor, the other spouse is full-time real estate. We saved them about $100,000 of tax. So my point is, on the cost seg, don't think it's only in the year that you bought the property. Don't think it comes down to when you place the property into service, what was the bonus depreciation that year, and you can go back retroactively. Another get out of jail free card.
Yeah.
So
and having these cards to be able to pull from time to time. We were talking ahead of the call, and I've got two parks that we haven't done them yet, and this happens to be the year that it will make sense, I believe. Of course, I'm going to consult with Chris here and assure, but yeah, I believe this will be the year that it makes sense to go ahead and do those, and both of those, fortunately, will be at the 100%. So that's awesome.
Right.
And one other thing, Chris, I think that would be maybe beneficial, because sometimes if we're thinking 100% bonus depreciation, 40% bonus depreciation, there's a significant difference there. But when you're investing in a lot of these properties, you're using leverage for part of it. And so, the actual cash that you need to put into these is going to be significantly less than the overall price of the property. And then that depreciation and the bonus depreciation comes off of, what the actual, as you said, improvement value is. And so, you can't deduct it from the land, but from the rest of it. So oftentimes it can be literally the funds that you're putting in can be offset almost dollar for dollar, if not dollar for dollar.
Right. So that's why we said cash flow and tax flow are different. You might put $50,000 into a deal. Your depreciation deduction is based on the asset purchase. The building portion of the asset purchase has nothing to do. The depreciation deduction has nothing to do if you paid cash for a property or leveraged 100% of it. Doesn't matter. What if you did a sub-2 deal and you put nothing into it? What if you bought some on a land contract where you put almost nothing down? You're just taking an underperforming asset off of someone else's hands, and you are going to run it. So you could put $0 into a deal and still get a depreciation deduction. It's just nuts. So you nailed it, Keith. Cash flow and tax flow are different. I've seen it tons of times where the deduction exceeds the amount of cash they put in. And if you can take that deduction, if you have material participation, your rep status, then bingo bango. Now, my third strategy, because here's one more thing I want to keep in mind. Tax strategies, they don't like to be alone, right? They like to play around with each other. So they need to be blended and stacked. So Keith, let's say in your situation, let's say you have someone that they were not a real estate professional in the past. This year they are. They're managing their properties. They have a $500,000 deduction sitting on their depreciation schedule that they're going to be able to take now since they're rep status and they have material participation. Guess what? You might have quit your W-2 job. You're not going to have $500,000 of income. You're thinking,
right.
Well, my third strategy then would be a Roth conversion. Maybe take the money out of your IRA, convert it to a Roth so it grows tax-free, and you would have, in the year that you're going to have a very low tax bracket. Or you could take a retirement plan distribution. Obviously, if you're under 59 and a half, you're going to have to pay the 10% penalty. But the point is, getting money out of your pre-tax accounts in the same year where you have a huge deduction, you want to maximize that deduction. You don't want to have a $500,000 loss from a cost seg and $200,000 worth of income. You're wiping out 12% tax rate, and you only get to carry forward 80% of the remaining amount. You want to pair those. So you blend or stack your strategies together. They don't live in a silo.
Yeah, that's great. Very, very good. Very good advice. Chris, I want to be, certainly, want to make sure that we're good on time, and you've covered a ton. And just as our previous conversation, it never seems like There's so much more we could dive into, but
Right.
are there some additional things on the active investor that you want to hit before we maybe turn it over to some questions to the audience here at
Yes.
the end?
Yeah, let me hit the last. I'll hit a couple. For active investors, think about income shifting to family members, right? So if you've got a real story, if we've got someone in our teaching tax flow community or our client base, we just elected S status. This person flips houses, makes a crap load of money. We're going to be able to pay them a small salary. And so their S Corp election, I already talked about that. However, his wife helps him with the business. They have about $30,000 in medical bills per year that they don't get a deduction for because of their income. We simply put the wife on payroll for a fair wage. So income shifting to a spouse, income shifting to he's got children that help with the business in a lower tax bracket, income shifting to family members. And then we implement a Section 105 plan where the S Corp reimburses all employees for any out-of-pocket medical expenses. Well, the only employee are family members. So we're not having to offer that to a bunch of random people. We just took thousands and tens of thousands of dollars that we were getting no tax benefit from and now making it a business deduction. So I'll wrap it with income shifting to family members, potentially providing employee benefits to family members, which could be health reimbursements, group medical, retirement plan contributions. Most real estate investors aren't so keen on building their retirement plan contributions, but at times, it might make sense. I like when you're paying your shifting income to children, assuming they're doing legitimate work for legitimate pay. I like pairing that with a Roth contribution for them and let that money grow tax-free. The final thing I want to talk about is the short-term rental loophole, short-term rental tax strategy. If you operate a short-term rental property, it is considered non-passive. If you have something called material participation, you don't have to meet the real estate professional status tests that I just talked about. Material participation, there are several tests, but the easiest one is I put 100 hours of time into managing the property and I put in more time than anyone else. You're going to pair that. That means you're operating your short-term rental property as non-passive. And then you pair that with a cost seg study. Now, it's not that easy, but if you're listening to this and you operate your own short-term rental property, talk to your tax professional, determine if you've done a cost segregation study and if it could make sense. Because like you said, Keith, tons of people bought in the Smoky Mountains in 2020, 2021.
Mm-hmm.
This is a year-by-year test. So I've had clients buy, manage it for the first year, soak up the bonus depreciation, and then say, all right, I'm going to turn it over to a third party moving forward, and I'll do it again and again, and they just build their portfolio that way. Again, don't let the tax tail wag the dog, but make sure you strategize. And I know you've been waiting for that. What's my third law of teaching tax, folks? I already said the first two. Your tax return is truly a verb and not a noun. That's it.
No, that's great. That's great. Chris, this has been amazing. I knew it would be. And thank you so much for joining us here today on the Wealth Flow.
It was my honor, and welcome everyone to jump in, to the Teaching Tax Flow community, teachingtaxflow.com. And then we have a private Facebook group just called Defeating Taxes. So if you just go to defeatingtaxes.com, anyone listening here, I'd welcome you. It's complimentary. We answer questions. We have once a week where we let people fire away questions and ask them for free. And we got tons of tax professionals in there. It's not just me. There's a lot of very talented people in that group.
Perfect. All right. Well, I hope all of the audience will take us up on that and certainly join Teaching Tax Flow and look Chris up. Chris, where else can people find out more about you?
Mm-hmm. Well, I'm on LinkedIn and Facebook. If you just go to Chris Picuro, it's hard to spell, but chrispicuro.com, there'll be links to all of my outlets. And we do a lot of content on LinkedIn and Facebook as far as tax strategies. So, yep, be happy to work. The good thing is I have a unique last name, so if you just Google it, you'll find me. There aren't too many accountants with this name.
Perfect. All right. Thanks, Chris. I think we'll call it a show. All right. I want to personally thank everybody for joining us both on LinkedIn and any of the other platforms where folks joined us here today. I hope my conversation with Chris opened your eyes to the exciting strategies you can use in 2025 to navigate the investment and tax landscape ahead. I do recognize, though, that we may not have answered all of the questions that the audience has regarding taxes. However, I'm happy to assure that each and every one of your questions do in fact get answered. And Paige Rotterman, our PR manager, has kindly agreed to help both Chris and I field any additional questions or recommendations about future virtual events. If you have any additional tax questions or recommendations or even feedback, please feel free to email Paige directly at the email address that you see below on your screen. That's going to be Paige, that's spelled Paige, at bobocapitalventures.com. And again, we have it right below me here on the screen. And we hope to, and we'll make a commitment to answering each and every one of your additional questions that you might have. And we welcome any feedback or recommendations for future events. Thank you so much again. Everybody have a fantastic day and make April